Markets fall for the third straight week on global banking crisis, rate hikes by global central banks and the amendments to the finance bill. The Nifty falls 1%, the broader markets underperform. Today on Editors Roundtable, we discuss the implications of the finance bill. We put the spotlight on IT and hospitality, and we take stock of GQG Partners in their portfolio. I am Reema Tendulkar, and with me today is Nimesh, Nigel and Prashant. Hi guys, I'm waiting for that sigh of relief. What a week, right?
Wasn't there? I mean, it was like such a tough Friday, yeah? I mean,
by the way,
so much of news.
We're still waiting for closure, right, with the STT.
Oh yeah, exactly.
So
nobody knows an end still. Yeah.
You know, you still get that lurking feeling that we're done for the week, markets are shut, but we're not done with news flow. Something's going to hit
I'll tell you, Reema, I woke up this morning actually thinking that it's going to be a nice, quiet Friday.
Relaxed Friday.
And you will slide into the weekend, and then, we'll see on Monday. And it just started, boom, right from the word go, right? With that debt mutual fund thing, which sort of caught everyone's attention. And then, as if that was not enough, mid-afternoon, people realizing that this STT is also a very big change.
In fact,
which
there were
is still
150 amendments, so to speak. I believe there were 150 amendments.
You were talking about some number of pages and...
It was 220 pages, the finance bill this time. Typically, it's 40 to 50 pages.
Yeah.
I think there are some 20 new sections and about 64 odd amendments.
Amendments, yeah.
Right? Typically, these things don't happen in the finance
And when
bill,
you thought all the domestic cues were done and dusted, suddenly you had the European banks that started collapsing.
Yeah.
Deutsche Bank down close to around 8%. So I take that point. Prashant, you thought you were going to have a nice, easy day. Anything but that.
And by the way, it almost felt like budget day,
Yeah.
without the sets and the
speech.
The free food, and anyway, let me just quickly tell our viewers what to watch out for. I mean, it's almost living life on the edge, right? It feels like that because things were settling down with the US banking issues, and the Fed was behind us, and the budget, of course, was almost 6 weeks old. Who would have thought that budget is once again is all we will be talking about this Friday? But that was the nature of the market today. So mood is pretty subdued, and I think Nimesh will attest to it as well. And I don't think there is any sort of indication that this mood is going to change on the dime, because what can happen, right? Imagine what can happen. I mean, of course, the unexpected sure can happen in a positive way as well, but doesn't look like it. The Nifty looks close to retesting the 16,800, 16,850 levels. We got 2 touch points on that level in the last 10 days. Both were respected, but, well, third time lucky, we will see. Tax increases on financial instruments also soured sentiment. It's not that the tax increases are huge or anything of that sort. It's just that, there was no mention of this of any of this in the budget. So what changed between the 1st of Feb and today for these completely new things to come about? Usually there are amendments to what is already included in the budget. And in any case, these are increases, right? So incrementally, they don't help. They hurt to whatever smaller degree. Global markets have been seeing this 1 step forward and 2 steps back at the kind of movement, just in terms of price action also. The reasons for the Fed's dovish shift and Yellen's comments are actually, in a way, worrying, right? So what did the Fed say? They said that, if this had not been the banking crisis, our forecast would not be 1 more 25 basis point hike. It could have been at least 2 more. I mean, about 2 more. And, Powell said that this is guesswork. But it does show you the direction. What they're essentially saying is they expect credit in the US system to be impaired. Credit will tighten, and that's the reason why we don't want to hike interest rates. On the other hand, the Treasury Secretary Janet Yellen's comments basically show you that they will not intervene on a blanket basis. The threshold of pain has to be high, and it has to be on the verge of becoming systemic, and then they will kind of step in. Again, not exactly the best kind of situation for the markets. And of course, as Nigel just said, do markets need to worry about big financial institutions like Deutsche, etc. out of Europe? One does not know. One is not sure. So we are hanging and living life on the edge, as I said, at this point in time. Let's welcome in Nilesh Shah of Envision Capital, who's with us for a quick chat on things. Nilesh, your first brief look at the market as we had today on Friday, and of course all the news flow with regards to all these budget changes. Very briefly, what did you make of them?
Well, I think it just proves one point that market does not like any bouts of uncertainty. Markets don't like any kind of tinkering and any changes which probably could hurt investor returns and things of that kind. So it can take some time for the market to be able to absorb all of this and move forward. But I think in an environment which anyway is impacted by a lot of things which are, I would probably call them as a bit ugly globally, I think, and then on top of that, if you have a bit of tinkering here and there on the domestic side, it just impacts the sentiment further.
Nilesh, hi, point taken. But before we get further, Nimesh has walked over to the big ball and there has been a big churn in GQG Partners India Fund. For more details on this, Nimesh?
Well, there has been a lot of chatter about what is GQG doing in India, and there has been a lot of rumors as well. So I thought, let me put a nice, data as to what GQG has been doing in the Indian markets. We all know that, Rajiv Jain has committed to nearly $2 billion to the Adani Group, but that happened in the March. But before that, just look at what have they done in the India portfolio. I was just comparing the emerging market fund of GQG. Now, if you look at the emerging market fund of GQG, their total India exposure has fallen from all the way up as high as 34% in December to 25% in February. So in December, between December and Feb, they have sold a lot of stocks. So what they have done to the individual names, in ITC, they were owning 6.5% of the total fund. That is the total fund of ITC was the highest weight. That in February seems to be largely out of the top 10. So they've largely sold a lot of ITC in those 2-3 months. Even Reliance, they were holding 4.2% of the total fund. That seems to be out in the Feb data. Similarly, if you look at SBI, they were owning 2.8% of the fund, and then in Feb, it actually looked like they've cleaned out in SBI as well. However, they've added some stocks, which includes HDFC Limited, where they were owning 5.1%. That holding has gone up to 5.7%. And in ICICI Bank, they've raised the stake from 2.9% of their fund to 3.7%. That's basically the total exposure that the EM fund had within the GQG holdings. If you look at the GQG Global Fund, even they have exposure to the Global Fund. In the Global Fund, they have made a small change. Their holding in HDFC Bank was 5% in December. That has now fallen to 5.1% to 5% in February. The total India exposure has slightly moved up from 7.1 in December to 7.3. This is all before they invested money in the Adani Group. Now look at GQG's top India holdings, and that will give a good picture. The biggest holding is ITC. They own 1.3% of the total company as of December 2022. As I said, they've sold some stake in ITC in the last couple of months. Cipla was the second big holding, 1.2%. HDFC Limited, Tata Steel, Sun Pharma, 0.7 to 0.9%. And the list goes on. JSW Steel, they own NTPC, Coal India, ICICI Bank, Bharti Airtel. These are the few big names that they own. Now, what have they done in terms of exits? They've sold Reliance, they've sold SBI, and they've sold ITC. Among the three names, Reliance has been a big underperformer since January. That stock is down 13%. Even SBI is down 17.5% since the December. Only one stock where they've sold and still the stock is up, that is ITC. So that's up 14%. But also I want to add one more line. They've also sold a big chunk of HDFC AMC last week, and they've cleaned out of HDFC AMC as well. So while they've committed good $2 billion to the Adani Group, but on the India portfolio, their holding has come down, and they've sold a lot of big names, which includes ITC, Reliance as well. And I believe in the March filing, there could be more names where they've reduced their holdings, in those names. So that would be interesting to watch. But I guess from a positioning point of view, GQG has definitely lowered down its India holdings across the board, and they've only added to the Adani Group in the month of March.
Nimesh, very interesting compilation over there. Nilesh, wanted to pick on that point about HDFC AMC. The developments which have taken place today have resulted in a knock in the stock prices, down close to about 5%. You like HDFC AMC. Do the developments alter the investment thesis in the AMC companies?
Well, in the very short term, it definitely is negatively impacted. I think this will impact maybe from a few quarters perspective, maybe 3 to 4 quarters. There will be some bit of impact. In addition to that, there's also the overhang that there's an expected change in the total expenses ratio that's already been talked about quite a bit. So I guess that still they will have a bit of a challenging time for a few quarters. But my sense is that I think it makes sense for investors to take that in their stride, because over the very long term, the long-term investment case for an asset management business, for a mutual fund business in India, I think is very solid, very robust. Penetration levels are still extremely low and have a long way to go to catch up even with some of the global emerging markets. So I clearly think that it's hard to come across a business where you can see compounded double-digit growth over a 5 to 10-year period with very high ROEs. I mean, the business is extremely capital efficient. So I think in the short term, I clearly think this is a bit of a negative, but maybe from a 1 to 2 years out perspective and beyond that, I still think this is a wonderful opportunity. You buy great businesses when they're facing the most difficult times. And we've seen this in the past, many great businesses getting impacted due to short-term sentimental reasons or a bit of changes here and there. But in the long term, the business is so solid that they end up being long-term compounders and long-term winners.
Okay, all right. Take that point on board, Nilesh, on those AMC companies. And talking about HDFC AMC, Nimish, I'm just wondering, GQG, are they making space to pick up something else? We'll have to see, so it will be interesting.
Yeah, of course, that filing, the March filing will be important, and the fact that are they looking to add, more value-added stocks. That's something which we need to watch out for. But there's been a lot of chatter, which is why I thought, it's good to put some numbers out. And the fact that they've sold the very large names like SBI, ITC, and Reliance in the last one quarter.
Well, it's going to be very interesting, but we'll wait by then to see what GQG does. For the time being, Rima has hopped across to the big wall to tell us what about the IT space. Rima, take us through the bull and the bear case arguments. Go ahead.
Well, so the IT index has been one of the worst performing indices this week. The index was down more than 3%, and they've taken the brunt of the global bank exposure and the turmoil that we've seen over there. So here I'm going to present the bull versus bear argument, stack up a few data points for you to decide. So first, on the bearish point, Street is worried about the direct exposure of IT companies to some of the impacted banks, whether it's Credit Suisse or SVB. But even the indirect impact, banks globally in US or in EU may turn cautious. They could look to cut back on their spending. There could be a delay in decision making, and all this is likely to hurt the growth rates of Indian IT companies, and the outlook is very uncertain. So JP Morgan says the current estimates do not factor in the increased EPS risk from a further slowdown in spending. Kotak says the current growth forecast is for an 8% growth, but that could be impacted by 1 to 2% given what we are seeing globally. CLSA says there are two scenarios. One, if the crisis is short-lived and contained. In that event, we're looking at an EPS impact of 2 to 3% for some of the large companies. But if the crisis is prolonged, it's larger in scale, then the EPS impact could be as much as 7 to 8%. And Ambit says there is a risk that the overall impact on BFSI could be longer term. At that time, it's not just FY24 EPS, but even FY25 EPS, which could be at risk. So basically, on the bearish side, there is a lot of uncertainty right now, whether the hit on the growth is going to be 1 quarter, 2 quarter, or it's going to be more prolonged and hurt, the growth rates for the next 1 or 2 quarters. Remember, BFSI is the largest contributor to the Indian IT companies. Now let's present what the bull case is. One, with the correction that we've seen in the IT names, valuations are actually closer to their 5-year average valuation. Look at the TCS number. Current valuations are 24 times, but the 5-year average valuation is just 25 times. For Infosys then, current valuations at 21 times, sharp drop-off from the peak levels of 28 times and closer to the 5-year average of 20 times. And it's a similar picture for Wipro as well as HCL Tech. For Wipro, the current valuations at 16 times, closer to the 5-year average of 15x. And for HCL Tech as well, current valuations at 18x, closer to the 5-year average. So that's point number one. Valuations are closer to their 5-year average valuation multiple. The second bullish argument is that margins have already bottomed out. They're on their way to recovery, and the recovery is only going to gather steam. The reason for that is attrition is coming down sharply. Wage hikes in FY24 are going to be far more moderate given the layoffs that we are seeing, and companies are looking to improve their utilization. Utilization has some headroom, and subcontracting costs are likely to come down. And the third argument is that Indian IT has corrected far more than the Nifty, the benchmark index. From the peak level, the Nifty IT index is down 24%, while the Nifty is down 10%, and the Nifty IT index is actually closer to its 52-week low, just about 7% away. Nilesh, where do you stand on the bull versus bear argument on Indian IT, and between the large caps and the mid caps? Which one would you favor?
Well, Rima, it's a bear case for large caps and a bull case for mid caps in IT. That's the way I would put it. The large cap, unfortunately, I think they'll find it difficult to grow in double digits. At best, their growth will be in single digits. even in a year like financial year 21-22, which was the best year for IT, a company like Infosys, probably the net earnings grew at just about 15-16%. So imagine your best-in-class company in your best year growing at just 15-16%. So we can imagine that when things normalize or in not so great years, the growth rates are going to be significantly lower. So it's pretty much like the FMCG space, where the large companies will find it very difficult to grow in double digits. And therefore, it makes sense to probably kind of take a look below the top 4 or 5 names and see where there's kind of incremental growth happening, where there's going to be a higher delta and therefore a higher alpha generation over the medium term. So I think at best, if there were to be a further correction, the large caps will give you nice trading bounces. But probably, I think the big upside is going to be in some of the mid caps, which are growing at a much faster pace.
Interesting point, Nilesh. Well, for the time being, Nilesh, request you to stay with us. We'll slip in a short break. We come back, though. We continue discussion with Nilesh, and we'll also take a look at the hotel sector on the other side.